Hello, in this segment of the course, we'll start talking about the role of banks in the economy. So first, what we see is that banks play a very critical role in the financial system. Part of that role is because they lend part of their deposits out and thereby create money in the economy. Loans give people money that previously did not have it to buy goods and services. Now, when we think about the role of why people take out loans in the first place, people don't take loans out of the bank just for the fun of it or just to have money laying around. People take out loans from banks for the purpose specifically of buying a good or service. If you're a small business taking out a small business loan, you're using that money to purchase perhaps a capital good or service to expand your business or improve your business. If you're an individual taking out, for example, a car loan, you're taking out the loan specifically for the purpose of buying a car. So therefore, when we see that banks take part of their deposits and use them to loan out money to individuals, they're giving money to people that previously did not have it to buy goods and services in the economy. So we'll see what influence that has on the flow of money in our economy and the reserve banking system that we have in place. So let's take a look. So as we were saying, banks give out loans to people, essentially giving them money through those loans to buy things that they previously were not able to buy because they didn't have the money for it. This is what we call a fractional reserve banking system, where part of the deposits are held as reserves and the other part are used as loans. So what we're going to see is that this influences monetary policy, because when the Fed adjusts the money supply and people deposit part of that money into the banking system, that's going to influence the deposits, the reserves, and the loans that the banks are able to make. What we see is that the Fed sets a minimum limit for the share of deposits that banks have to hold as reserves. The remaining amount they can loan out. So what this is called is the reserve ratio. It's the share of deposits that banks hold as reserves. Essentially, we can think of this as total reserves divided by total deposits. So let's take a look. Here we can see for one bank, Bank A, their assets and their liabilities. Liabilities or deposits go into the liabilities column because when you deposit your money into the bank, you assume that you're going to be able to take that money out. So essentially, it's a liability for the bank in the sense that they have to make sure that they have enough of that money available so that when you come for your deposit, and you will be able to pull out the money that you need. So when someone deposits $100 into the bank, into their bank, Bank A, we see that the deposits of that bank grow by $100. The banks can then hold part of that as reserves and loan the rest out. So here what we see is that the reserve ratio is 10%. That means that 10% of that $100 is going to be held as a reserve, just in case you come back for your money. And the other part, the other 90%, is going to be loaned out. So here, what we think is that banks essentially take a gamble and assume that you're not going to come back for all of the money in your checking or your savings account at one time. They're assuming that you might pull some money out here or there, but the rest of it is going to stay in your deposit account. So part of that they're going to hold as reserves, and the rest they're going to loan out. And the difference between their deposits, the interest that they pay on deposits, and the interest that they get from their loans is going to give us the bank profitability. So that's essentially how banks make money. That's bank business. So what we see is that when they loan out part of the deposits that they're holding out to borrowers, banks essentially create money because those loans provide money to people who previously did not have it to buy goods and services. So let's go through an example here. Let's assume that our friend Lou decides to deposit $100 into his banking account. So we see that for Bank A, deposits grow by $100. If the bank holds 10% of their deposits as reserves, then we see that reserves increase by $10. The remaining 90% can be loaned out. Let's say that Jane goes to Bank A to get a loan. She gets a loan for $90. Now, Jane is going to use that $90 to buy new supplies for her business. She buys those supplies from Bill. So from this example, what we see is that Lou put his money into the bank. Part of that money went to Jane. Jane has to pay that money back to the bank, but for now, she uses that $90 to buy goods and services that she previously couldn't buy because she didn't have the money. She buys them specifically from Bill. Now, Bill doesn't really care where Jane gets the money from. He doesn't care if it's a loan or if it's borrowed from her sister or if it's money from her own savings account. For Bill, he just wants to get paid. So when Bill gets that $90, he deposits it into his bank. So for Bank B, their deposits grow by $90. They hold 10% as reserves, or $9, and loan out the rest, the remaining $81. They give that loan to Tim. Now, Tim is going to use the $81 to buy new tools so that he can work on a project for his business. So he buys those tools from Sal. Again, Sal, just like Bill, doesn't really care where Tim got the money from as long as he gets paid. So Tim didn't have the money himself to purchase the tools that he needs for his job. He went to the bank to take out a loan to be able to finance the purchase of these tools. Eventually, he has to pay that money back. But for now, Sal gets the $81 in exchange for giving Tim the tools. Sal then goes and deposits that $81 into his bank, Bank C. Again, Bank C is holding 10% of the deposits as reserves, so their reserves increase by $8.10, and they loan out the rest. They loan out the rest to Sarah, and Sarah uses the $72.90 to buy a new machine for her shop. And she buys that machine from some individual that, again, just like Bill and Sal, don't really care where the money comes from as long as they get paid in exchange for the good or service that they're selling to the person who's taken out the loan. So in this sense, what we're seeing is that from that $100 deposit that Lou put into his bank account, that has facilitated the flow of money or the provision of loans to a number of individuals already. So we've seen Tim, Sarah, and other people that are borrowing from the bank, able to facilitate economic activity, buy goods and services that they previously could not have because they've gotten a loan from the bank to do so. So in that sense, what we see is that money is going to continue to filter through the banking system until there's no more money left out to loan. So these three banks, through their loans that they've issued, $90, $81, and $72, have put a total of $243.90 into the hands of three people that needed it to buy goods and services. That money was then deposited by the people that they bought the goods from into their bank accounts, and the money continues to filter through the economy. Therefore, what we see is that these three banks essentially created, through the deposit and loan process, $243.90. That money had allowed three individuals to buy goods and services they previously could not have. And those individuals paid people who then deposited the money into their accounts after they've been paid. So this process continues through the banking system. And it has an important implication when the Fed increases the money supply. So let's say the Fed increases the money supply by $100. If people that get that money supply, so if they buy $100 worth of government bonds from Lou, he gets $100 from the Federal Reserve in exchange for that. So just like Lou deposited his $100 in our first example into the banking system, it'll be the same situation here, where through Lou's deposit into the bank, that money is going to filter through the entire banking system through the deposits and loans that people make, and therefore create money. So what we can say is that there's an increase in deposits by $100 from Lou. Therefore, loans increase by $90. And in fact, what we see is that if we stop at just that first bank, there's a new money supply. The $100 that the Fed has increased, plus the $90 that the bank has created by giving a loan to a person that needs it to buy a good or service. So we see that there's an increase in the money supply that will filter through the banking system, and money will be created by the deposits and loans that banks, by the deposit and loan process of the banks. So what we see then is that the fractional reserve banking system is creating money, but it's not creating wealth. So even though through the loans, people get money in their hands so that they can exchange that for goods and services that they need to buy for their businesses or other purposes, we see that that's not wealth, because eventually that money needs to be paid back to the bank. So when we say that the banking system creates money, it's not creating wealth, because that money eventually needs to be repaid. So how can we calculate the impact of the money creation process? Well, we use what we call the money multiplier, which is the amount of money the banking system generates with each dollar of reserves. So it essentially is telling us by how much would the money supply increase as it filters through the whole banking system. The money multiplier is going to be equal to 1 over the reserve ratio. So in our previous example that we were looking at, remember that banks held on to 10% of their deposits as reserves. So in that scenario, we would take 1 over 10%, and that would give us a money multiplier of 10. So what we see here is that if Lou receives that $100 from the Federal Reserve because they bought his bonds and gave him the $100 in exchange, and he deposits that money into Bank A, we see that it filters through the banking system, through the loans that are then deposited into the next bank, which issues loans based on part of the, holding part of that as reserves and loaning out the rest, which are then deposited into the next bank. And that continues to filter through all of the banks in the economy until there's nothing left to loan out. So we see that the change in the money supply is the $100 that the Federal Reserve has increased, plus the $1,000 that the banking system has created through the loans that it generates. Now, where is that $1,000 from? Well, we take 100, the money supply, times 1 over the reserve ratio, which remember is 10%. So we have 100 times 1 over 10%, which gives us 100 times 10, which gives us 1,000. So we see that the banking system from that $100 deposit has created $1,000 by issuing loans to individuals that need the money to buy goods and services. That exchange then is deposited into the banking system, and it filters through the whole banking system. So let's work on an example here. Let's suppose that the Federal Reserve increases the money supply by $1,000, and the reserve ratio is 12.5%. So we want to know what is the money multiplier and what is the new money supply in this fractional reserve banking system. You can pause the video at this point, try to go through the calculations on your own, and then come back for an explanation. So if the Federal Reserve increases the money supply by $1,000 and the reserve requirement is 12.5%, that tells us that banks are required to hold at a minimum 12.5% of their deposits as reserves. So there's nothing stopping the banks from holding more than 12%. So banks can choose to hold 20%, 30%, 15%, but they cannot hold less than 12.5%. Okay, so what does that mean for our money multiplier? Well, we do 1 over 12.5%, and that gives us a money multiplier of 8. If we look at the new money supply in this fractional reserve banking system, well, the $1,000 times the money multiplier 8 is the $8,000 that have been created by the banking system, plus the 1,000 that the Fed has increased the money supply by. So our new money supply is going to be $9,000, 8,000 of which has been created by the banks, and 1,000 of which has been through the expansion of the money supply by the Federal Reserve. Okay, so what have we learned in this segment? Well, we see that the banking system is a critical part of the economy because it contributes to the money creation process by loaning out part of the deposits that it holds. It essentially, therefore, creates money by putting money into people's hands in the form of a loan that previously did not have that money to buy goods and services that they need and want, usually need. The Federal Reserve sets the money supply, but we can see that their estimates sometimes may not be perfect because the Federal Reserve, when it changes the money supply, also needs to take into account how much money is going to be created in the banking system. If they expand the money supply and all of the people that get the money from the Federal Reserve in exchange for the bonds that they have sold to the Federal Reserve, and they deposit that into the banking system, well, the Federal Reserve needs to think, how is that going to influence the money creation process? They have to take into account the reserve requirements that they set, but also the reserve ratios that banks have. So some banks, again, as I've mentioned, may hold more reserves than is required by the Federal Reserve, but they cannot hold less than the reserve requirement. So the Fed has to take into account the fractional reserve banking system when it's setting the money supply, since it cannot perfectly control the amount of deposits nor the lending rate above the reserve requirement. So if the reserve ratio is greater than the reserve requirement that the bank sets, that means that the loans that they issue, banks issue, are going to be smaller than the Fed expects at the reserve requirement. So the Fed has to think about that as well. So not only is the Fed just expanding the money supply, but it needs to think about how that money filters through the entire economy in the banking system through the money creation process. Of course, it's a great idea to always take a look at the textbook and read through this to practice and understand this material in greater detail. And be sure to also go through the exercises associated with this segment of the course so that you can practice your understanding further. Thanks so much for joining me.